Assalamu alaikum and welcome to the Oasis Focus on Finance show. I'm your host, Shafiq Morton. As always, it's great to be with you. Today's show is the first of a three-part series on retirement fund tax reforms. As we all know, there's been a lot of debate and tremendous political heat surrounding this question. On the 1st of March 2016, government will introduce new legislation concerning tax and pension funds. The reason for this is that statistics reveal that 6% of South Africans, only 6%, will be able to retire comfortably at the level of their lifestyle when they are working in this country. That is something that is quite scary. This is the underlying reason for government's change of heart in terms of tax reforms. Joining us in studio today to have a look at the context of these particular changes is Hugo Barnard, tax expert at Oasis, and Jehan Ebrahim from Oasis Advisory Services will join us later in the show. Now, I think the first question we have to ask is there's context to these changes, isn't there? How do we understand government's wish to try and transform the whole pension fund landscape with these tax reforms?
Shafiq, the retirement tax reforms are essentially a number of amendments that were made to the Income Tax Act pertaining to the provisions that govern tax aspects relating to retirement funds. Now, these provisions are for the better, and in the long term they'll improve the lives of the working class in South Africa. But before we get into the details regarding these changes, let's just look at the background and the reasons why National Treasury and government has gone down this road. The retirement savings in South Africa, like in many other countries, is essentially a barometer for the social and economic health of the country. Now, it's no secret that South Africans don't save enough. In fact, we have one of the worst saving rates in the world. Now, from a retirement point of view, this means that when you come to retirement, you simply don't have sufficient retirement savings to last you and sustain you through your retirement. The knock-on effect of that is that people have to rely on their families, their communities, or on the state for their social and economic well-being. From a pre-retirement point of view, it means that people start making use of debt to finance their lifestyles. Now, that is probably one of the easiest ways to erode your quality of life, is when you go down that road. If we can improve the retirement savings rate in South Africa, it would do away with this need to access debt to fund lifestyles. We'll reduce our dependency on debt, we'll reduce our dependency on the state, and overall we'll improve the lifestyle of our retirees. National Treasury and government has identified this, and in order to improve the savings culture in South Africa, they've identified a number of initiatives. One of them is to hone in on the retirement savings, and the reason for this is simple. The retirement savings is one of the biggest savings industries in South Africa. It's also the most tax-efficient savings vehicle in South Africa. Now, from a retirement savings point of view, what they've identified as one of the biggest stumbling blocks is that people are able to access their retirement savings far too easily, both before they retire as well as at retirement. Now, what happens is when people change jobs, they are able to access up to 100% of their accumulated retirement savings at that date, which means they can take it as a cash lump sum, and what they do with it is out of our control. Now, as part of the broader retirement fund reform, National Treasury is looking at implementing what is referred to as compulsory preservation, which means that when you change jobs, you won't be able to access 100% of your accumulated retirement savings. Instead, you will be required to preserve a portion of that until the day that you retire, which is normally around 55 years of age. This is just the first part. Presently, at retirement, members of a Provident Fund are able to also access 100% of their retirement savings. And this is where the biggest change comes with these tax changes. And it's also where the most debate is around, is this compulsory annuitization. With the new tax changes, Provident Fund members will be required to annuitize at least 2/3 of their retirement savings. There are some technical details which we'll get to a bit later. But that means that government's trying to make sure that your retirement savings to the date of retirement is preserved and will last you through your retirement, instead of taking all of it as a cash lump sum when you retire and then squandering it in a shorter time period and then ending up being dependent on the state and on your family. There are other changes relating to the deductibility of your contributions to Provident pension funds as well, which we'll deal with a bit later. So, broadly speaking, these tax amendments will ensure that the tax aspects of all the different types of retirement funds are aligned. In the industry, that they refer to as tax harmonization. All the tax treatment for all the different types of funds will be the same. Now, this will result in broad spectrum improvement of the post-retirement life of our retirement community, and in the end will reduce the dependency of that community on the state.
Now, Hugo, you've mentioned Provident Funds and harmonization of these funds. I think we get a pension fund, a Provident Fund, and a retirement annuity. Just take us through these three categories quickly.
Most aspects of the South African history, our retirement history, is also a colourful history. From a legislation point of view, South Africa was actually the first country to govern retirement funds through an act of parliament. Despite this initial initiative, we, unlike most other countries in the world, or many other countries in the world, we don't have a compulsory national retirement scheme or national pension scheme. In fact, as much as 60% of our retirement fund members are invested in private sector retirement funds. The Pension Fund Act this year will be 60 years old, and through the decades, it's gone through a number of changes. So changes in the retirement fund industry is nothing new. There's been sections bolted onto the Act, there's been sections taken out, and there's been amendments to sections. So these changes is nothing new. If we go into the details of these funds, the pension fund is probably traditionally the most well-known one and also the most favoured one. A pension fund usually takes one of two forms. It's either an employer-sponsored pension fund or it's an occupational fund. Both employers and employees can contribute to these funds, and at the date of retirement, the pension fund will pay out an annuity to the members. Now, in recent times, there's been changes to this where the pension funds no longer pay this themselves, but they buy an annuity for the member in the name of the member. With your defined benefit plans, where the pension funds are responsible and the employers have to sponsor this, that's where some of the larger companies in recent times got into a bit of problems because their members were outliving their pensions and growing to be older than what their actuaries had initially estimated. From a Provident Fund point of view, we should take into account that Provident Funds and pension funds effectively work in the same way with regards to contributions, governance, etc. The big difference between the Provident Funds and the pension funds is that from a Provident Fund, you don't have to annuitize. There's no obligation on the Provident Fund to make sure that the employee gets or the member gets an annuity after retirement. And that is where the big change comes in the South African environment. From a tax point of view, the deductions for pension funds can be or contributions to pension funds can be deducted, but currently Provident Fund contributions cannot be deducted. Once again, another aspect that will change, which we'll touch on later. The retirement annuity funds is slightly different, and they were originally developed for people that weren't in formal employment. They were working for themselves, your doctors, your professionals, to allow them to save towards retirement in an environment that is similar to the pension funds. So the rules on annuitization is the same as pension funds. You still have to annuitize 2/3 of your retirement annuity savings, and your deductions to your retirement annuities are also tax deductible. Your contributions are also tax deductible. The added benefit of a retirement annuity is that it's a lot more flexible as a pension than a pension fund. You don't have to be employed by a specific employer to belong to a retirement annuity. And like I mentioned, it's for people that are self-employed. You can decide on the level you want to contribute. You have flexibility in changing, increasing, decreasing, or even stopping your contributions to your retirement annuity fund. You have a bit more say in what you invest in that retirement annuity fund by being able to select the annuity fund that you want to be in. Also, the savings is in your own name, so it's not in a pension fund, and when you change from one job to another or from one sector to another, you don't have to change funds and take care of the admin and things like that. So it's a lot more flexible than the other two types of funds.
Hugo, just in terms of what we've been discussing, do you think that what government has proposed, for example, the preservation of 2/3 of a pension fund in the long term, is going to take a lot of burden off government in terms of people being able to be more comfortable at the retirement age?
Shafiq, that is ultimately one of the reasons why they're trying to implement this. The previously, the Provident Funds, where there was no requirement to annuitize, it comes from the 1980s, 1990s, when our country went through a lot of changes. And call them lower income working class in the mining sector, your industrial sector, energy sectors, those guys entered into the Provident Fund because the pension fund scheme didn't really suit their needs. Many of them are from the rural areas, and when they retire, they go back home. And you can imagine someone every month having to walk great distance to go and collect their pension check. The infrastructure was just not in place. That's why the Provident Funds were developed, especially in the Labour constituency, and that's also the guys that are making the biggest noise about these changes, is to the benefit of their members, so that they can take this money when they retire, cash, and go back home, and then they can spend it in the way that they think best. Now, times have changed, technology has changed, the sector has changed, the industry has changed. So it's much easier these days to ensure that money is paid out on a monthly basis. And over the long term, if we enforce this when this compulsory annuitization for Provident Funds is enforced, over the long term, it will ensure that people's retirement savings last them for their full retirement, and they don't take the cash lump sum at retirement and spend it in 5 years and then become wholly dependent on the state. Ultimately, that is a big burden for the state.
Hugo, let's get back to what we were discussing, the three kinds of pension funds, provident funds, retirement annuities. You mentioned something called tax harmonization. What do we mean by this?
With tax harmonization, we mean that the tax aspects around retirement funds, all three different types of retirement funds, will now be aligned, which means all of them will enjoy the same tax deduction for contributions, all of them will have annuitization, all of them contributions will be deemed as fringe benefits, so there's no differentiation between the tax treatment anymore. The two main aspects relate first to deductibility, which I've mentioned, and the second to annuitization. If you look at the deductibility, in your pension funds and the retirement funds currently, you are allowed to deduct your contributions to those funds. The pension funds is 7.5% of your retirement funding income, and the retirement annuity funds is 15% of your non-retirement funding income. Now, with the changes, these will be aligned, and across all the funds, you'll be allowed to deduct 27.5% of the higher of remuneration and taxable income, including the Provident Funds. And of course, currently, there is no deduction for Provident Funds. That is one of the big changes. They've also implemented, interestingly, a cap of 350,000 Rand on your deductions annually. National Treasury says the intention behind that is to get vertical harmonization between your higher income and lower income earners that contribute towards retirement funds. Now, viewers must remember that in future, your employer contributions to retirement funds will be deemed to be or be taxed as a fringe benefit, which means it will be added to your taxable income. However, at the same time, it's also deemed to have been made by you and will fall into the contributions that qualify for a deduction from your taxable income. From a payroll point of view, there might be small changes with the take-home pay, but there shouldn't be decreases in them. They will see changes to pay slips, the reclassification of contributions to deductible contributions, etc., but there won't be big changes to take-home pay. It's not expected in any event. Secondly, and more importantly, there's this concept of compulsory annuitization. Like I've mentioned, in your pension fund and retirement annuity funds presently, you are required to annuitize 2/3 of your retirement savings when you retire, but now this is coming in for Provident Funds as well. Present, there's no requirement to annuitize your Provident Funds, but as from 1 March 2016, you will be required to annuitize at least 2/3 of your Provident Fund savings. Now, there are very technical aspects around this annuitization, but suffice to say, and this is across all the retirement funds, if your retirement funding income or your retirement savings is less than 247,500 Rand, you won't be forced to annuitize. There's always the option, and it's always a good option to annuitize, but it's not forced upon you. The law provides that in that instance you can take 100% of it in cash. Now, if you look at the technical aspects around this, in order to not prejudice existing Provident Fund members, the law provides for what is called vested rights. So if you are a member of a Provident Fund, you may ask, so what's happening with my Provident Fund savings before the 1st of March 2016? The rights that you had to those Provident Fund savings are protected, which means that all the money that you've accumulated up until the 1st of March 2016, you can still access 100% of that when you leave your Provident Fund. It is only your savings from 1 March 2016 onwards and the capital growth on that will be subject to the new rules. And it's only once those savings reach the 247,500 Rand limit that there will be forced annuitization. If it's less than that, they can take the whole amount in cash. Now, if you are 55 years or older on the 1st of March 2016, you can effectively disregard these changes because you can still cash in pre- and post-provident contributions and savings. But we must warn the viewers that in the event that they're considering changing jobs, they must consult their tax advisor or financial advisor, because when you transfer from a Provident Fund to a different fund, you may lose your vested rights. It's very important that they take this into account.
Hugo, we've certainly absorbed quite a bit, but I think what we're going to do now, we're going to cross to Jehan Ebrahim, who's been talking to clients, do something of a comparative study in terms of what we've been discussing. Jehan, assalamu alaikum.
Thank you, Shafiq, and assalamu alaikum to you and our audience. The retirement tax reforms can seem very daunting, and I've gone through many queries from clients recently, but it really is very simple to understand. For the purpose of this show, we'll go through each type of retirement fund and look at where we are now and what will happen as from 1 March 2016. I want to stress that although I'm going through this information and comparing the changes, if you are unsure about your options and what is happening, you are most welcome to call Oasis and we'll answer any questions and provide guidance and advice to you. What I will be covering in my comparison is contributions made by the employee, what happens on withdrawal, what happens at retirement, and what will happen if you need to transfer your funds. Okay, so let's start with pension funds. It's going to be easier for you to see this on a table which will come up shortly. Okay, so let's look at member contributions currently. The employee may deduct contributions to the pension fund of up to 7.5% of approved remuneration for tax. But going forward, the employee may deduct contributions to their pension fund of up to 27.5% of taxable income or gross remuneration, whichever is higher obviously for tax. Now, the 27.5% limit applies to the aggregate of contributions to all funds. There is an overall tax deductible limit of 350,000 Rand per year. The 350,000 Rand will include the cost of any risk cover to the fund. Contributions in excess of the deduction limits may be rolled over to future years, but it is subject to limits applicable in those years. So let's look at what happens at withdrawal. Currently, the full amount may be withdrawn as a lump sum net of tax. As per the changes, the full amount may be taken as a lump sum net of tax still applies. This may be changed at a later date, but there are no laws at this stage and we will inform you of those changes when they occur. Now, if we can look at what happens at retirement currently, up to 1/3 may be taken as a lump sum subject to the retirement tax table, and at least 2/3 must be used to buy a compulsory annuity. Currently, compulsory annuitization applies to fund balances above 75,000 Rand. As per the changes in March, up to 1/3 may be withdrawn as a lump sum subject to the retirement tax table. At least 2/3 must be used to buy a compulsory annuity. Now, in terms of compulsory annuitization, it will apply to fund balances above 247,500 Rand. This is where one of the main changes occur. Finally, with pension funds, if we look at current transfers, this can occur tax-free to a pension fund, a preservation pension fund, or a retirement annuity fund. In March, transfers can occur tax-free to a pension fund, a preservation pension or provident fund, or to a retirement annuity fund. So really, minimal changes, as you can see, occurring on the pension fund side, but advantageous nonetheless. Now let's move on to provident funds. Provident Fund members are most affected by these changes, as they will effectively switch to the pension fund model, which requires the purchase of a compulsory annuity at retirement with the 2/3 of their fund balance. However, their so-called vested rights will remain under the old rules. So looking at the table in terms of the rules for current member contributions, in terms of member contributions currently, we see that the employee may not deduct contributions to a provident fund for tax. But come 1 March, and this is where the changes have occurred for provident funds, the employee may deduct contributions to their pension fund of up to 27.5% of taxable income or gross remuneration, whichever is higher for tax. And then, as with pension funds, the same will now apply. There is a 27.5 limit to contributions. There is an overall tax deductible limit of 350,000 Rand per year, which includes risk cover costs. Contributions in excess of the annual deductible limits is rolled over to future years. Now, looking at withdrawal currently, the full amount may be taken as a lump sum, net of withdrawal lump sum tax. From 1 March, this is unchanged as with pension funds. What happens to provident funds at retirement currently is that the full amount may be taken as a lump sum, subject to retirement tax tables. And of course, there is no compulsory annuitization. Now, as of 1 March, this is where the main changes occur to bring provident funds in line with other retirement funds. So net of any vested rights, up to 1/3 may be taken as a lump sum, subject to retirement tax, and at least 2/3 must be used to buy a compulsory annuity. Now, the vested rights is the employee's provident fund balance on 1 March 2016 and the subsequent return thereon. This may be taken as a lump sum net of tax. And as with pension funds, provident funds will follow compulsory annuitization rules to fund balances above 247,500 Rand. And finally, if we look at what is happening on the transfers currently, this can occur tax-free to a pension or provident fund, a pension or preservation provident fund, or to a retirement annuity fund. Going forward, transfers can occur tax-free to a pension fund or provident fund, a preservation pension or provident fund, or a retirement annuity fund. A lot of changes, as you will see, on the provident side, but from 1 March it will operate and be governed by the same rules as the pension fund and the retirement annuity, which I am going to go through now. Okay, so in terms of current member contributions, the employee may deduct up to 15% of non-pensionable income. Pensionable income is the income used by the employer to calculate contributions to the company's pension or provident fund. Contributions over the annual limit may be rolled over to future years, but will be subject to the limits applicable in those years. Unclaimed contributions are returned tax-free at retirement, added to the tax-free portion of the cash lump sum. But going forward, as with the other two funds, the employee may deduct contributions to their pension fund of up to 27.5%, where this limit will apply to all contributions to this fund. There is an overall tax deductible limit of 350,000 Rand per year, which includes risk cover, and contributions in excess of the deduction limits may be rolled over to future years. If we look at what happens at withdrawal currently, it is not possible to withdraw a retirement annuity other than at early retirement due to ill health or formal immigration, or if the fund balance is less than 7,000 Rand. In those instances, the funds available can be taken as a lump sum net of withdrawal lump sum tax. Going forward, this is unchanged. Now, at retirement currently, up to 1/3 may be taken as a lump sum, subject to retirement tax, and at least 2/3 must be used to buy a compulsory annuity. Compulsory annuitization applies to fund balances above 75,000 Rand. Going forward, the same applies, except that the compulsory annuitization applies to fund balances above 247,500 Rand. And then finally, in terms of transfers, this can only occur to another retirement fund, tax-free or otherwise. And the same is true going forward. Back to you in studio, Shafiq.
Jehan, thanks for that. Okay, Hugo, let's quickly summarize everything that we've discussed in this evening's show.
Tax harmonization rules will effectively result in equality of tax treatment across all the different types of retirement funds. The biggest changes be on the deduction side. You'll be allowed a deduction of 27.5% across all the retirement funds, including the provident funds. And the second being that there'll be compulsory annuitization of at least 2/3 of your retirement savings for the Provident Funds as well. This will ensure that members have an income that can sustain them through the retirement, and they'll be less dependent on their families or on the state for retirement. If you are 55 years of age on the 1st of March 2016, you can effectively disregard these changes because you'll still be able to cash in 100% of your Provident Fund savings. But if you're on less than 55, it is only the savings up until the 1st of March 2016 that you'll be allowed to cash in.
Hugo, thanks for that. A special thanks to our guests in today's show, Hugo Barnard, Oasis tax expert, and Jehan Ebrahim from the Advisory Services. This has been the first in our three-part series on retirement fund tax reforms. Of course, they take effect on the 1st of March this year. Should you wish to contact Oasis, you can dial 0860 100 786 or email info@oasiscrescent.com. Until next time, I'm Shafiq Morton. Assalamu alaikum wa rahmatullah.